Happy New Year, and welcome to another edition of Market Moves presented by Sgroi Lawley. My name is Vincent Scarsella, Head of Research and Investment Development, and today we will be discussing the major market themes that played out in 2025 and discuss what we could see in 2026. The stock market had another strong year in 2025 as the S&P 500 saw a total return of 17.9%, which marks the sixth year out of seven that the S&P has posted a double-digit gain and has nearly doubled in value since the market bottomed in October of 2022. The Nasdaq gained over 21%, and the Dow, although lagging both the S&P and Nasdaq, still had a nice year, rising 14.9%. Small caps also saw a double-digit return as the Russell 2000 saw a positive return of 12.8%. The returns in 2025 can really be split into two parts. The first being from the beginning of the year to early April, as tariff uncertainty struck some unknowns into the financial world, which caused some volatility. Markets were relatively stable up until mid-February, with the S&P up around 4.6%. Once more and more details were revealed about the tariffs, markets plunged and we saw an aggressive pullback, with markets bottoming on April 8th. From February 19th to April 8th, the S&P lost 18.8%, the Nasdaq dipped 23.8%, and the Dow lost 15.4%. Small caps were not immune to the selling pressure either, losing 22.7%. After President Trump announced a pause on these reciprocal tariffs on April 9th, markets shot higher and really never looked back, which is where the second part of 2025 begins. Once this pause was announced, the major equity indices never looked back as the Dow rose 29.3%, the S&P gained 38.7%, small caps were up 42.4%, and the Nasdaq went parabolic, rising almost 53%. This rise was not just because there was a 90-day pause. The tariffs in general had less of an overall impact on the economy than what was expected. Companies adapted, some tariffs were scaled back, and consumer spending remained strong. All of this propelled markets higher, and on top of this, the Federal Reserve cut interest rates 3 times during the year, totaling 0.75%, which also eased pressure on the economy. The path this year was not without volatility. March was the worst month of the year for the stock market. Selling pressure intensified with rising uncertainty about tariffs and trade policy, and these concerns escalated into early April, with investor anxiety spiking and the VIX, which measures fear in the markets, surging above 52, which is very, very high, as any number above 20 can be considered highly volatile. For reference, the only times in the last 20 years it has been higher was when the economy shut down due to COVID in 2022 and during the Great Financial Crisis in 2008. This shows how quickly sentiment can reverse and how sharp drawdowns are a natural part of market cycles. Hopping overseas, when both indices were positive, this was the first time since 2017 that the international markets have outperformed the US. The S&P 500, going back to 2008, has outperformed the international index 13 out of 18 years. With the US dollar depreciating against other foreign currencies, this was an added tailwind. All in all, international stocks posted a return of 33.1% this year, outperforming the S&P 500 by over 15%. Turning to fixed income, bonds had a strong year as the Barclays Aggregate Bond Index rose 7.3%, and interest rates all across the curve came down. This was due to the fact that inflationary data came in mostly lower from month to month, the Fed cutting interest rates, and tariff policy not as impactful on the economy as was feared. Corporate bonds and high-yield bonds were the top performers in 2025, rising 8.6% and 7.9% respectively, as this part of the bond market is highly correlated to the US economy and company debt as well. Turning to commodities, gold had a banner year as the precious metal gained 63.7%, while silver recorded a gain of 144.7%. Much of the gains in both metals can be attributed to investors wanting a major hedge to any shocks to the economy, fiscal and monetary uncertainty, and strong demand from ETFs and central banks. Bitcoin did not fare as well in 2025 as it lost 6.4%. And if we look back to when the Bitcoin ETFs were introduced to the public markets in January of 2024, it is up just over 100% in that time frame, while gold is up 117.6% and silver is up almost 232%. However, if we look back to 2014, Bitcoin is up an eye-popping 15,000%, or an annualized return of 54.5%, more than trouncing the S&P, which is up 334% or 13.55% on an annualized basis in that same time period. As we start the new year, the developments in Venezuela will remain in the headlines, but despite this, the macro and structural drivers that underpin the 2025 rally remain intact, and they support a constructive outlook for global markets. The Fed is likely not done with policy easing and will most likely cut interest rates at least one time, given a sluggish labor market and contained inflation. Shelter cost pressure looks to be falling, wage inflation is easing, and the labor market could continue to show signs of weakness. And with the Fed's dual mandate of inflation and labor, more cuts could be on the horizon then. This would provide a meaningful boost to economic growth throughout the year. Fiscal stimulus should support global growth as well. In addition to looser monetary policy, three sources of fiscal stimulus could bolster the US economy: tax refunds from the One Big Beautiful Bill, delayed spending from the government shutdown, and government spending on defense and infrastructure. This should therefore broaden out equity performance, as corporate earnings in the non-AI segments would benefit more from this stimulus. While there could be geopolitical volatility, the outlook for global equities remains positive. Thank you for tuning in to this edition of Market Moves. If you have any questions, please do not hesitate to call our office or visit our website at sgroilawley.com.